In the previous lesson, we looked at effort, result, harmony, and divergence on different phases of price action. It's also important to look at the more general market so you can also spot specifically tops and bottoms. Not every time is it always going to give a nice structure for you or a nice single candle reversal or whatever. But you want to be able to just, regardless of the phase, be able to look at the price in a trend after an extended trend and understand, are we likely to be reversing? So there's two ways that can happen, which are through trend climax or trend exhaustion. So trend climax, as this image shows, tends to finish with high volume and a divergence. Divergence meaning smaller price advances. But you don't always get both. So you see here, at the bottom, we get high volume and we get a divergence in the sense that the high volume doesn't follow through. At the top, we also get high volume and we get a cleaner divergence in that we get smaller price advances. So we have a high volume candle. We then have two more subsequent upthrusts, each of which on lower volume, decreasing volume, price still rising, above key high at the end of an extended trend, divergence likely at top, trend climax with high volume. With the bottom, trend climax with high volume. But it doesn't give you those extra confirmations. It just gives you one strong high volume reversal, still a divergence, still valid. Those are two typical ways that each trend will end and begin to reverse. Trend exhaustion is the one that is worth more note at this point, because this will not fall into the effort versus result. This will not really follow the principles of harmony and divergence, because at times there are reversals that occur when there is just nobody interested or a lack of interest in the market. So small volume after a downtrend at the bottom or small volume after an uptrend at the top is also a sign of reversal. Because if price is moving in one direction and suddenly there's a lack of sellers or a lack of buyers, there's no interest in going in that direction and it will reverse. So you can see here that after initially a bit of a move, it goes for quite a while with low volume, below average volume, price just meandering sideways, slightly down. It might look as if this is just going to go lower, but especially once it starts to make a move a little higher, you say, actually, there is just a lack of interest here from sellers to push us any lower, and that can lead to reversal. The big impulse doesn't come until the bottom is well in. So in understanding lack of interest, you can catch on to the subsequent trend up a little earlier. Similarly at the top, we initially move up, but on very, relatively low volume, slightly above average, but overall this area was a low volume area. Then declining volume as price just again meanders sideways, lack of interest. Nobody really wants to push us higher. And so what happens? Eventually, it sharply moves in the other direction. And the reason it moves so sharp when there's a lack of interest on either side, it quite often has a very strong impulse because there was no real interest anywhere on this move, on the up, on the sideways. And so the down can be a brutal down candle or up candle. And those are particularly good to catch as longs or shorts if you're able to spot them. So covering that off, it'll help you identify when a movement may be ending in every possible way. You can have harmony, divergence, or lack of interest. So that should help you. You now have a full grounding of price action, how it behaves in the most important areas, and we can get into the next topic.